In the collective mind of the market, dark clouds are again gathering over China's outlook. Highlighting this was the response to the April data round, which endured through the May release. Over the 2 months, key industrial indicators disappointed expectations, with year-to-date growth in industrial production languishing below 4%, and the gain for fixed asset investment slowing from 5.5% year-to-date at February to 4% by May. Questions have also been raised over the consumer, as momentum in retail sales trailed the market's ambition. We continue to believe, however, that the market is underestimating China's growth capacity. What is required to prove this? Greater confidence amongst households and businesses, and a little patience. In our view, the principal driver of China's 2023 growth will be the domestic consumer. Albeit short of the market's expectation, year-to-date growth of 9.3% at May speaks to discretionary consumption's capacity to stimulate aggregate growth. The 23% gain for the subcomponent covering eating out also makes clear consumers' intent to return to normal life. Unlike the developed world, inflation in China is negligible, so not only do households have lockdown savings to spend, but also recurring real income growth. The wealth of most households is also in a strong position, with new home prices recovering prior losses as demand recovers. Although, at present, the weak state of the secondary housing market is still creating anxiety in many cities. But for GDP growth to beat the market's expectation in 2023 and beyond, robust strength in investment is also necessary. While weak inflation aids household spending capacity, it also shows there is excess capacity across existing industry. This slack is unlikely to be used up quickly, and so future strength in investment needs to come from the creation of new industry in importing competing sectors within China and opportunities targeting China's own competitiveness, structural growth in Asia ex-China, and looking to the medium term, the global green transition. Amid uncertain times for the developed world, and with the regulatory uncertainties of recent years still fresh in entrepreneurs' minds, this necessary development could easily be delayed. It may also be overwhelmed by the ongoing deterioration in developed world demand, should fears of a deep recession in the US or Europe begin to crystallise. What we see, therefore, is a need for greater confidence amongst consumers and businesses. Cue policy support. So far, initiatives have been limited to very small interest rate cuts. Undoubtedly, though, additional direct stimulus is being readied. Here we are not talking about aggressive support for old industry or the accumulation of more debt by already indebted households for housing investment, but rather accelerating organic growth in the economy to instill confidence in its structural health and innate capacity to grow. Mooted in the press, support for home upgraders and first home buyers fits this bill. So would additional aid for developers while the pipeline of projects is rebuilt from historically low levels. Aid for local governments would also be constructive, given they have already undertaken a rapid acceleration in utilities investment, and with a pickup in revenue from property sales still some way off. Sooner or later, though, the ambition of authorities must turn to incentivising business investment by the private sector, leveraging the aforementioned structural growth themes. This is where China has had considerable success in the past, and where the opportunities lie for the decades ahead. If they are successful in building confidence and new capacity, growth of around 6% is still readily achievable in 2023, and gains circa 5.5% in coming years probable. While commensurate with the outcomes we expect from the likes of India and Indonesia, growth at this rate with a focus on capacity and national income will set China apart from the developed world, where economies increasingly look set to be mired with a deteriorating capital stock and a dearth of productivity growth. We'll see you next time.